It's March 31st, 2025, and this is Pyratt. The NASDAQ 100 index has been the greatest beneficiary of the AI gold rush. Investors have been using the NASDAQ 100 QQQ ETF to gain exposure to the AI boom. This is an AI-driven gold rush for the ages, in which market participants have been undeterred by Federal Reserve interest rate intrigue, geopolitics, war in Ukraine, macro risks, or even sky-high valuations. Everyone has wanted a seat at the greatest poker table of the millennium. But there may not be enough chairs on the Titanic if things go south. The index, which has been the main vehicle for speculation in AI stocks, the NASDAQ 100, is smooth, it trends well, and it has massive liquidity. However, the latest correction has driven home an age-old lesson. The most sophisticated market participants always look away from the main action to the second and third order effects of the AI boom. The smart money remembers the adage that in any gold rush, do not bet on the miners, bet on the picks and shovels plays, just like the California gold rush of the 1800s. This is the only conservative way to play the AI boom. Until late 2020, natural gas pipeline stocks have been dropping for years and going sideways. Some natural gas pipeline companies sported enterprise value to EBITDA ratios below 8 going into early 2021. More recently, natural gas pipeline companies have had a big run, but most still sport enterprise value to distributable cash flow ratios of 10 to 14, while the tech-heavy NASDAQ 100 sports a PE ratio of greater than 22. Natural gas is the backbone of power generation. Electricity powers AI. It might be time for the greatest picks and shovels play of the century. When you combine the AI theme with the fact that most electric cars are synthetically powered by the nat gas used to generate almost half of the electricity they store in their batteries, you get a mega theme for the next 50 years. Moreover, weakness in the electrical grid means that data centers increasingly seek power directly from major natural gas pipelines to fuel the ravenous appetites of their AI clouds. For a given level of technological sophistication, the only limit to AI's reach is the electricity used to power it. Investors are only starting to get it, and the natural gas pipeline stocks are starting to behave accordingly. Natural gas pipeline companies recently have been raising dividends, trending higher, and gaining recognition for their central role in the AI value chain. But they are still reasonably priced. Companies like Energy Transfer and Kinetic are actually quite cheap. What is remarkable is that pipeline stocks have continued to trend higher uninterrupted even as natural gas hit a 30-year low before bouncing strongly recently. It was an enormously bullish signal when the AMLP index, which is heavily weighted to natural gas pipeline companies, was rising even when natural gas was falling last year. What does this mean? Natural gas pipeline companies are paid fees based on the volume of natural gas that goes through their pipe. Their fees are generally not based on price. Therefore, it is a clear signal that the market was extremely bullish on natural gas volumes, even as natural gas prices were dropping precipitously last year. Picks and shovels plays are always the enduring winners of any gold rush, and happily for the shrewd investor, they are always priced far more rationally than the companies at the center of speculative fervor. Remember, listeners, if you don't want your income to be based upon trading time for money, money won is always infinitely more valuable than money earned.